The stress test may be causing more harm than good. Regulators should always have a good assessment of the financial viability of the firms that they are supervising. Out of a political need to do something, they're coming up with a core set of rules to assess the financial health of institutions now. The problem with that is that that test may not be compatible with the test they traditionally apply. There's no doubt that financial institutions have difficulties, but there are some serious unintended consequences when you change the rules along the way, when you just out of a hat pull a new set of rules. In particular, in vogue is right now that banks should be very cautious about the counterparty risk. That's absolutely right. But if you just have a simple white paper that says, look at your counterparty risk, then what may happen is that banks that are encouraged to reduce their counterparty risk may focus on the less profitable relationships, namely to get rid of counterparty exposure to very low risk, boring bread and butter businesses, and may focus on the riskier relationships because they're more profitable. In the eyes of the regulator, they'll be safer institutions afterwards because they have less overall credit exposure, but in the end, banks will be giving less credit to the financial system as a whole and may not be any more stable whatsoever. Instead, what we need a market-based approach. Obviously, regulators need to do their job, but market participants will always be faster than regulators. So what you need to do is you need to put a set of incentives in place. You need to lay some ground rules so that the greed is geared towards the right direction. You also want to have things in place so that when an institution fails, you don't have the systemic risk. One way to achieve that is to force financial institutions to have 10% of the loans that they extend as part of subordinate debt. And basically the goal here is that periodically financial institutions need to go out into the marketplace and raise more money. If they fail to do so, they need to shrink their loan portfolio. So what you can do is you can, for example, have the subordinate debt have a maturity of 10 years and you stagger it over 10 years. So every year you need to refinance 10% of your loan portfolio. Now, with a very simple mechanism, you have a market force in place that shrinks the balance sheets of the banks if the cost of refinancing, of raising that money, is too high. And that's what we need. We need to have a market-based approach. Now, I'm not saying that that is the bullet solution to all the problems we have, but what we need to have, we urgently need to have a discussion, a constructive discussion on how to move forward, rather than just blaming everybody and then coming up with these ad hoc stress tests that, in my view, may cause more harm than good. Ultimately, what we need to achieve is to have the money flow from weak hands to strong hands. It can't be that we prop up bad institutions with government money when we have thousands of banks that are perfectly healthy but can't compete because the bad banks have government guarantees. So we need to have a mechanism to drain the money from the bad banks and have it move to the good banks. And the sooner we get on that path, the better. I'm the portfolio manager of the Merk Hard and Asian Currency Funds. Please subscribe to a Merk Insights video and go to merkfund.com to subscribe to our newsletter.